A popular question investors often ask is whether now is a good time to invest. It gets asked when markets have been going up and all-time highs are being reached because there's a concern that, well, things can't just go up forever, can they? It gets asked when the news turns negative because things could always get worse. The current environment seems a little more like the second than the first. Just look at this list, which you can probably add to with a little news watching or listening. Markets have been responding to all this bad news for most of 2022. Stock indexes have fallen over 20% by the end of June, and bonds, with the Fed aggressively raising rates to fight inflation, well, some of those bond indices had fallen over 10%, the worst performance over a 6-month period on record in the U.S. But with all these well-publicized troubles, is there perhaps a silver lining for investors? What if all this bad news and subsequent market responses has actually produced an environment where future expected returns for stocks and bonds are now higher than they were just 12 months ago? Why would today be a time of higher expected returns than 12 months ago? Well, this graph from Vanguard shows how the majority of an investor's return from bonds is derived from the income paid by the bond. The higher the interest rate on the bond, the greater the income return. Investors buying bonds today are expecting, with good reason, returns more than 2 times higher than they would have expected just 12 months ago. With today's higher yields, expected returns for bonds have risen substantially. Are there reasons to think that stocks now have higher expected returns than just 12 months ago? Well, the price to book ratio is used as one indicator for how expensive or inexpensively stocks are trading. Valuations today versus 12 months ago are significantly lower. So stock investors today are buying companies on sale relative to prices 1 year ago. All things being equal, paying a lower price for an entire stock market has the effect of raising future expected returns over a longer period. And you can see how some of these largest research firms are adjusting their long-term expectations from where they were even 6 months ago. Again, citing a recent publication by Vanguard, this graphic shows how they've adjusted their 10-year stock and bond outlook, raising their ranges of expected returns by 1% or more per year for stocks and 1.5% or more per year for bonds. But maybe the best answer to the question, is now a good time to invest, is simply to look at market history. Looking at history, the expectation of investors should be a future that includes new market highs. Why? Well, profit motivations for investors and entrepreneurs in larger companies have aligned in the past and still align just for innovation, technology, productivity, and providing solutions that people are willing to pay for. You know, the uncomfortable truth for all of us as investors is that some uncertainty is always present. One way to become more comfortable with uncertainty is to understand the past in ways that help form a reasonable view of the future. It's especially helpful right now to see how the current environment may have also created higher expected returns than just 12 months ago. As always, thanks for watching. We hope to see you in a couple weeks.